Welcome to America's Commercial Real Estate Show. I'm Michael Bull. This show is your source for intel, forecasts, and success strategies, and I sure appreciate you being with us. We have a great show for you today, and this segment is brought to you by CommercialAgentSuccess.com. If you're an experienced agent and want to hone your skills, do check it out. Well, today we're talking multifamily, and what a great thing to be talking about, because it seems to be that and industrial seem to be the darling sectors, and it's had great growth. Well, what should we expect moving forward? In this show, we're going to have tips for you as an owner, operator, manager, or someone who helps those who are. And we're going to start off by talking about the market and see what's going on there. Please welcome my guest, Jay Parsons. He's VP with RealPage, and he's joining us on the Skype today. Jay, thanks for being with us. Thanks for having me, Michael. So Jay, like I said in the opening, it seems like multifamily has been doing well for so long. You know, I've talked to you in the past, and it's like, is this going to continue? And you're like, yeah, it's still continuing. It's crazy. But have things softened up some? Where are we today?
Well, it's softened up, but I think the better word is normalized a bit. Everyone's talking a lot about how supply is going up so much, rent growth has passed its peak. But I think what's probably not getting enough attention is that apartment demand remains remarkably robust.
Yeah, and that seems crazy. It seems like it should soften at some point, but
yeah.
You know, is it because we're getting job growth? Is it because that even some baby boomers are maybe saying it's okay to rent an apartment now?
Yeah, I think it's several things. I mean, first of all, everyone's so concerned about millennials aging up and buying houses, and of course that is happening. I mean, no one really believes that millennials never buy a house or rent a house now that rental single family is a viable option as well for many folks. But there's a couple things that are going on. Number one, we still have solid job growth across most markets in the country, and where we don't have job growth in some spots, it's because unemployment rates are so low. And while some millennials are aging up and buying houses, you still have a lot of young adults entering prime apartment renting age, meaning coming out of college age, starting to rent that first apartment so that that front door remains open. And then baby boomers, as you mentioned, there's a lot of talk about people leaving their homes and renting apartments. You know, we don't think that's happening at any grand scale, but if you think about it, the baby boomers are twice as large as the previous generation ahead of them. And so even if the same share choose to rent apartments, that's still an awful lot of additional apartment demand. So there's been a lot of demand. I mean, just in this cycle is now in its 9th year, and we've absorbed nearly 2.2 million units on net over that period. It's really remarkable, and it's more than the units we've delivered in that time frame.
Yeah, it's amazing. I mean, I have a primary home, and then I have a second residence, and I really wish my primary home was an apartment. I mean, it would just be easier, right? Less to deal with. So what do you expect for demand continue? Do you think it's going to continue? How long is this great demand going to be here?
Well, we think what's happening is we see a lot of the analysts and institutions who look at multifamily and look at broader commercial real estate. We think that it's pretty simple. I mean, a lot of times people forget that apartment demand is simply tied to demographics and the economy, and there's a lot of, I think, overanalysis going on around the apartment market. And so it's really quite simple. If you believe the overall economy will continue to do decently well, then you should believe apartment demand should be strong. Apartment demand tends to benefit from job growth and from demographics. And so we know that demographic trends are going to remain favorable for the next decade, so that's a check. And then as long as job growth remains at least moderate, then apartment demand should continue to be strong. Now, it's not going to keep up with supply probably through 2018 and 2019, but we think the demand will be strong enough that the gap is narrow enough that occupancy rates overall remain pretty solid, and that rent growth remains, you know, in the mid to high 2% range, maybe the low 3s, which is pretty much where it's been now for the last year and a half.
Yeah, well, that's interesting. We're talking with Jay Parsons with RealPage about the multifamily market. So it's normalized. So what is normal?
Well, if you look at the long-term norms, it's always dangerous. I mean, people talk about reversion to the mean, and the mean is sometimes a little bit misleading because you just average out good times and bad times, you get to sort of an artificial norm. But I think what we're really getting to is just a stabilization or normalization where we're seeing much more consistency in the overall market. Rent growth has been in the mid to high 2s now, as I mentioned, for a year and a half. Occupancy has been hovering from the right around around the 95% range, and which is actually high, but we're not seeing any more growth, obviously, in occupancy. But conversely, we're not seeing vacancy spikes like many had forecasted. But as you look deeper in the data, we could dive more into this if you'd like, but it's not, obviously there's a lot of bifurcation within the data, within the markets, within the segments, by class. Certainly if you're urban Class A, there's a lot more challenges than if you're suburban and Class B.
Yeah, and is that because of new supply, that most of the new supply has been urban?
Absolutely. No secret that investors and lenders and developers have all favored an urban strategy in this cycle. You could certainly make an argument that's been played out, and there's been a ton of supply in those kind of spots. You're dealing with concessions and in some cases rent cuts. But there's been very little supply in the suburban areas, and at least on the whole, we're growing the suburbs at a clip of less than 2% in terms of inventory growth, compared to around 6% in urban submarkets across the country. And what's happened is two different things. Number one, no one's really building in the far out speculative suburban areas. You think about what happened in the bust, taking some 10,000 acres of ranch land in Phoenix way out and turning it into 1,000 apartment homes, 10,000 single family houses, and a Walmart. That's just not happening. And then where you really want to build in these infill suburban areas with good demographics, good schools, access to transportation, retail, all those things, those are the places where it's just hard to build. And we've talked about this before, but you got NIMBYism, you got restrictive zoning, and we really believe that's where the true barriers to entry exist. It's not the downtown submarkets anymore. That's been proven. It's really these desirable suburban areas where it's really hard to get deals done. Yeah,
I mean, the politicians in those markets just feel like, hey, those apartments might be nice today, but in 15 or 20 years, we're not so sure that we want them here, right?
Yeah, there's that, and there's also still some outdated mindsets from citizens who show up at city council meetings saying that they don't want apartment residents going to their schools. Even though number one, that shouldn't necessarily be a concern. Number two, not a lot of kids actually live in conventional apartments. So there's several factors at play there. But again, bottom line though is there's true barriers to entry that exist in these desirable suburban areas.
And what do you see, Jay, for kind of B apartments, maybe some of the older complexes? How are they faring now?
This is really the sweet spot. If you're Class A, particularly urban, obviously you're competing with supply. If you're Class C, that's where you start to run a little more into the affordability concerns. You're catering more for a working class job segment where you're not necessarily seeing the same income growth that we're seeing in the white collar segments. But if you're Class B, there's a true barrier to entry. In fact, you're actually losing stock in Class B because there's been so much value add play. People buying Class B assets, upgrading them to a B+, A-, A asset. Obviously, you can't build a Class B property due to the laws of with the cost of construction and land and everything else. And so as a result, you're dealing with a demographic that can afford rent growth and also a lot of demand for these Class B units because the gap in rents between a Class B and a Class A property is higher than ever. And so what this means is that even if your Class A new properties are offering concessions for a lease up, they're still not going to pull out your B renters because it's going to take 4 or 5 months free to even out the rents. And so we think Class B is incredibly well positioned going forward. In fact, operators in many markets of Class B are probably being a little too conservative on rents because there's a true barrier to entry on supply. That gap to rent to Class A is so significant. And so a lot of spots, we think this could really be, if you're just looking for NOI growth for yield, this could really be a strong play over the next 5 years.
Yeah, that's a good point. We sell apartments and we sell a lot of Class B stuff, and people love them and they do well with them, and I agree there's a lot of growth. And you mentioned rising construction costs and land costs. So how is that, and especially construction costs, I mean, how is that potentially going to impact multifamily? Might that curtail new supply?
Yeah, we think there's a number of factors that will lead to a slight decline in supply. We think supply on an annual basis will remain north of 300,000 units through 2019. From there, you're going to see some moderation, and there's a few factors. Obviously, construction costs are getting more and more expensive, and what that means is you have to make it pencil out. You got to get high rent properties, which are by definition mostly going to be more urban, and that's where you start to run into a lot of additional supply. So a lot of investors and lenders are getting much more apprehensive about funding those deals. Then conversely, like I mentioned, the other alternative is to build these infill suburban areas, and there's just a limitation on how much you could do. And so by the time we're looking at going out a year and a half, 2 years. There should be we should start to see some declines in what's actually delivering for those reasons.
Yeah, and what do you hear about the Fed's view of multifamily today, or the lenders' view? Are lenders still kind of gung-ho on multifamily generally?
Yeah, it's interesting. I mean, there's different indicators. You look at the Federal Reserve's survey of senior loan officers, and it would indicate that lenders are significantly tightening their underwriting standards, and there's some apprehensiveness toward multifamily. But then you talk to lenders, you go to these industry events, and you just don't see that same nervousness. I think there's still a lot of enthusiasm around multifamily. You look at banks, their balance sheet exposure to multifamily as a portion of their overall balance sheet loans continues to grow. And so I think overall lenders remain pretty bullish on multifamily. I think what you're seeing is maybe a little more pickiness in terms of the sponsors they want to work with. They're focusing more on long-term relationships. They're not necessarily entertaining a lot of new relationships, particularly for construction loans. When you look at the regulatory agencies, I think there's still maybe a little bit too macro of a view on multifamily. And I look at some of the notices they put out, and frankly, I think they significantly lack nuance. Not understanding that a lot of the issue is top end and urban, and particularly as you look at valuation and pricing, it's a very different story if you're urban Class A versus pretty much anything else. And I think that's really missing from their viewpoints.
Yeah, that's a good point. You can't put them all in one bucket. So Jay, to leave us today, where do you think there might be some opportunities maybe for new construction for Class A properties, and what cities around the country might be good, or maybe some B property markets where maybe there's some good upside for rent increases?
Yeah, I mean, obviously everybody has a different strategy, and I think there's still opportunity. It's just going to, we've talked about this in the past. In previous parts of this cycle, 3, 4, 5 years ago, a rising tide boosted all ships. You could do anything. You could be the worst operator, the worst developer, and you still do pretty well. Yeah. Obviously now we're at a much more strategic point in the cycle. And so a few things. If you're a developer looking to build, I think a lot of folks have been nervous about maybe paying that price to get in to the most desirable high-end suburban areas, because they still are scared off by that suburban tag, and so they may walk away from a potential deal. Even if it was an urban deal, they'd be willing to pay that price, or it looked like a great deal. And those spots, I'd be willing to push the edges a little bit. In fact, even on the types of development that we do, if you're in a high demand, high employment, we're talking high end employment, suburban area, what does get built tends to be kind of your typical garden or wrap properties. Very few folks are willing to kind of push the edges on higher end properties. And I think that's where there's opportunity. I mean, you look at places like Plano outside of Dallas, you look at the Tech Center in Denver, or Alpharetta in Atlanta. I mean, these are high-end areas with all the demand drivers you're going to want, and we have kind of ho-hum apartments for the most part. So I think there's opportunity there. And you look at Class B, I'd really be looking at those strong job growth markets, high demand markets where you're insulated. There is supply, but it's also because there's a lot of demand, particularly in the Sun Belt, Denver, Seattle, places like that. And so in those spots, you're going to be insulated from Class A. And even if the market slows, you know that those are the kind of markets that will bounce back if the job market tanks, and it's going to come back. And those are the markets that will bounce back pretty quickly. And so there's minimal risk in those markets as well. So those are the spots I'd be looking at. Yeah, well, those are great tips and great information as usual, Jay. Thank you for joining us on the show today. My pleasure. Thank you, Michael. And if you'd like more information from Jay, visit their website. It's RealPage.com. Well, stay with us. We'll have more on the multifamily market in the U.S., including some tips for operators. Stay with us. I'm Michael Bull. This is America's Commercial Real Estate Show.